and then spent time creating something that would give information to the bot in order for it to determine exactly how to take trades. It was doing option trading, and it worked pretty well. It had other issues. I mean, it there were some other issues with how it operated, and so over time, I ended up basically converting all of that data into something that was actually useful, and that was how this got started. And it was this is market score, so it was just this indicator right here. Um, what ended up happening was, is I showed it to my nephew, who's a full-time trader, and he looked at it and he said, "So what are you doing with this?" And I said, "Well, I was going to use it to help my bot be able to learn how to be able to trade better, blah blah blah." And he goes, "So are you going to market it?" And I said, I hadn't really planned on it. He goes, "Here's what you need to do. You need to make a chart for this, and then you need to put it out there." And so I built this, and then I built this chart with it. And then once I did that, then that was, I mean, I was seeing correlation, but he was seeing significantly more correlation than I, because he spends a lot of time looking at this stuff. And so he said, okay, so this is something you should definitely figure out how to market. And so then I spent the time, and I was broadcasting just these two pieces here. But at the same time, I already had all the charts and I was already downloading all the data. So I figured I might as well figure out how to have this learn how to do the trading. And so I started to create a model around it. And originally it was just all of the trades were flat, meaning that it was taking all the trades. And then I, showed it to him a couple times, and he's like, well, because of how you've got market score where you have an upside and a downside, and they're separate, because, and to put it into perspective, buyers and sellers are unique in the market, meaning there are people who are biased to longs and people who are biased to shorts, and the way they operate is not always congruent on each other, meaning just because somebody's not a buyer doesn't mean they're a seller, and just because somebody's not a seller doesn't make them a buyer. So the strength and weakness for the long side versus the short side has a factor in there. I think I've waited long enough. We're going to start recording. I may have to actually add some of that back in, but we'll deal with that later. Okay, so I'm going to start recording. So if you,
Stacy, can you hear me?
yeah,
Oh, Frank is trying to join. You gotta let him in.
yeah, I'll give it.
Okay.
I'm going to give it one more minute, but
Oh, he told me he was waiting.
he's waiting.
Yeah.
I don't show. Oh, sure enough, there were
Oh,
two people waiting. I didn't realize that they were waiting. I apologize.
sure.
Okay,
Oh,
so now I'm going to go ahead and start the recording. Okay, so long story short, what ended up happening was, is that so the upside and the downside are mutually exclusive, meaning that people who are trying to get long, or people who have strength in going long, aren't necessarily going to immediately cause the shorts to have weakness. And that's the reason why there's an upside and a downside. They do not necessarily completely, just because the upside is just because we're moving up doesn't mean that the shorts are stopped being short, or that the selling has stopped. So it's understanding the strength of them. And you can see this on some of the charts when both upside and downside are moving up, or both upside and downside are moving down, meaning the numbers are going down or the numbers are going up. Those two things happen and have happened. They're not quite as common, but at the same time, that's why there's two separate numbers. So long story short, over time, it developed into me to building this more clear trading model. And then as I was going through it, I started to realize that I wanted the data to be a little bit more focused on TPO market profile, which is how I actually do my trading. And so that's when I introduced the chart version of market score. And I already had the value areas and the value data, meaning the settle and the POC and the open. I already had those on the charts, but I wanted to be able to provide reasons or how the model would behave based on that data. And that was ultimately when so initially I added just what I called caution trades, which are trades that are against what is currently happening, meaning if there is a trade that is already active, so you can see, and I'm just going to go through this relatively quickly, but you can see, so any trade that's just black, by default or gray by default. I guess I should say dark gray by default. That means that it's just a regular trade. A trade that is yellow, that's a caution trade. A trade that is gray or silver, that is called a focus trade. And then there are trades that are red, and you'll see them as I'm going through. And those are extreme caution trades. Now, here's the thing. Some of these trades will show you that they work. And the way that you read this chart, really all you're looking for is HBP, which stands for heat before peak, and max. And this tells you, and it calculates every minute, it will update with new information. And the idea is, how much heat did it take before it reached whatever this number is? All of the rest of it, the entry is kind of helpful. I mean, it's important to note the entry, but don't think that you either, if you didn't get in at that entry, that you're now screwed, or that if this entry is the entry, that if you get in a better entry, that it's not as that's not the goal, because this is just a reference. And these numbers down here are just the totals based on whatever the data is. So when it gets in, when it gets out, this is not something you should be paying attention to. These three columns right here, so the entry, the heat before peak, and max are the main columns you should be paying attention to. So the time obviously would have effect on what the entry. This entry is just whatever the market is at the time when it opens that trade. That's all it is. Now today, I don't know how many of you were on the stream, but I think the entry was 09, and it immediately dropped. I didn't get in right when it hit that entry, because I saw that it wasn't necessarily stable, and it dropped all the way down to 4. And I'll pull. Actually, I'm going to pull up that chart right now. So this is the ES chart. Come on, let me know when you guys can see it. You guys seeing today? Yeah, you're seeing today's chart. Okay, so you can see this right here shows the entry of 09, but you can see when I'm going to highlight it. You'll see that it will highlight in blue. So it was actually, and that candle that it's showing isn't the actual candle it got in. It got in immediately after that. So you can see that it was dropping at that point, right when it would have gotten in, that red candle right there, right after, right where the red arrow is. So I waited, and when it got down to, I waited and I got in around 4. And that, you can see that it never came back. So, I mean, this, if you had gotten it at 9, you would have taken 6 and 3/4 points of heat. But I got in at 4, and this thing got down to about 2.5. So I took about 1.5 points of heat. That was it. That was all the heat I took. Now, I didn't ride it all the way up to 20, and the objective of this, and this is the power of these focus trades. They're meant to be taken multiple times. So if I got in at 4, so I got in right around here, I could have ridden this up to like wherever this is, like 7.5, I guess would be right about where this is. I could have gotten out, let it come back down, get back in again at 4, ride it up again. And mind you, if I had done that the second time, I would have been, actually, I think I did do it the second time. I did get in it for it the second time, and I wrote it up to 11 or something like that, or just before 11, and I think it took me out. I'm sure you guys, some of you were in the stream, you guys could correct me, but I don't remember the exact, but I remember I didn't write it the entire time. But the bottom line was, you can take this trade multiple times and you can see it. And then if you had stayed in that trade, you could have ridden it all the way up to 12-ish, so, and then it comes back down to 5. You could have gotten back in because it didn't reach the level of, and by the way, we're still way below this original entry. Gotten back in at like 6.5, and then ridden it all the way up to 20. And pretty much if you got in at 6.5, there is literally, it never comes back to your entry. You're riding that thing all the way up. So even though this is only showing up one time, this is not meant to be used as I take this trade once based on the data that's there. The idea is, clearly you're going to have to be able to read it and know what the market is doing, or at least follow what the score is doing down here. And this is the other thing. The strength of the upside never wavered. It did come down a little bit right here, but it was still, the upside was on top and constantly moving up. And then while this is happening, it was making new highs. Like you can see over here, we have 8 highs for the upside. And then as we go, so during that move up, we got some more highs and now we're at 14 highs. So that shows strength in the direction that of the upside, which is what that focus trade is. And so even though this did dip a little bit, it didn't come down to where they were getting close. And I'll show you some days. I mean, you can see where it crosses over back here or where they're really close to each other. The idea is that because of this strength in market score, it it potentially would have given you the confidence to get back in. And keep in mind, it's not like I'm getting in 72 contracts every single time. If you take it the first time and you're like, okay, I think this is a good trade. It looks like it's solid. It's coming down. It's basically hanging out. And you get in at the 4. You get in. Let's say you get into 3 or 4 contracts. And mind you, I'm talking MES. I'm not even talking ES. You get in 3 or 4, maybe even 5 contracts. You write it up for 2 or 3 points. You take that, you get out, you let it stop you out, it comes back down to your entry. Maybe this time you don't take it for the full load. Maybe this time you only take it for 3 contracts. You get back in, you write it up, it gets up to 11, you get back out. Then this time when it doesn't ever even come back to 4 and you're getting back in, maybe this time you go back to full load. And that's kind of how you need to sort of look at this. It is not meant to be, I'm taking full load every single time, because there are times when it won't necessarily work out. And there are times when it does it twice and then it fails. And that's the reason why you don't want to like give it like a 15-point stop. NQ is a little bit different. I'm going to actually pull down the NQ chart for today. It's a little bit different, but not dramatically. It's the same principle. So this is the NQ chart. Same principle applies. The trade happens. You can see it's right there. It does a retrace, and it does a retrace of 23 points. I would not have gotten in as soon as it got to wherever it was. I would have waited to see what it was going to do. And I didn't trade NQ today. At least I didn't trade it. I traded it pre-market. I didn't trade it here. And then it came back down. I probably would have gotten in when it got below 780. So it got down to like 772. So I would have taken 8 points of heat. But again, on the NQ is a whole different ballgame, because if you get in, it never got back to that entry, as opposed to the ES where you would take it multiple times. If it never gets back to your entry, then you wait a little while and see what it does. Give yourself let it go 3 or 4 points above, maybe give yourself a couple ticks in profit and just sit and watch it. See what the price action is. Don't just assume that just because it went up 5 points, I'm going to jump and follow. And not to say, I guess, let me rephrase that. If you're a scalper, maybe that's your strategy and maybe that works and maybe that's how you want to trade. I am looking for longer term. I want to be in a trade. I think my average time in a trade is like 10 to 20 minutes. So I have a very different trading style. How you trade this is going to be based on how you want to trade. But at the same time, understand that this data is fluid. It's not going to be an exact, when this thing pops up, it's not saying get in the trade immediately or you're going to be left behind. It's these numbers, when this number pops up, I would say 95% of the time, you are going to be able to get in at that level or better. And when I say at that level or better, I'm talking at least 1 to 2 points better. On NQ, obviously, it would be, let's say 15 points better. But it is very rare that this number pops up and you can't beat it. Very rare. On the NQ, like I said, if you got in at, just a little bit below 780, you would have basically been able to hold out and watch this thing go up. And by the time that it gets up into above 800, so you're in at 780. Once it gets above 800, it never got below that. Again, you're 20 points in profit. Maybe put your stop 10 points in profit and let it run. See where it goes. It's the same kind of thing. And NQ was easier for the long term and harder for the multiples, because if you got into the trade and got out, now it's never coming back there. You're like, when do I get back in? And it was, I don't remember who it was, but someone in the stream said something about there was a caution. and I think it was in the ES. There was a short trade, so you can see it right at, I don't know if it's going to pop up. Oh, there it is. Okay, so you can see it, this red arrow right up here. So if you had gotten in a long and you were in this long all the way up to here, when this trade popped up, that was saying that the information was enough to get into a short trade, which may be a time where you're going, maybe I don't want to be in my long anymore. And maybe, that's a point where you decide to get out of that trade. And that's part of the reason why, I mean, a lot of people have asked me, why do you have so many trades showing up when I'm not even using that data? The thing is this data is relevant. It may not be relevant for the trade you're taking, but it is relevant for the market and how it is behaving. And again, like, that would not have been a bad trade if you had taken this short. And I'm not saying you should, I'm just saying that that trade would have worked. This trade would very much have worked. If you had taken that short, it would have very much worked. You took 0 heat for a potential of 18 points. Mind you, the 18 points was all down here, so it probably would have been only like, let's say 10 or 12. But it still, these trades will work depending upon it. But at the same time, it's how you have set up your information. Okay, so now I'm going to go back to the basics and just sort of give you an understanding of what this is and how it works. So value area is based on the movement of the market, and it takes calculations and looks at where it is at during the time of the day, during that time, during the cash session, of where it is at and how it behaves, and it tracks it for 70% of the places where it is, and that's what the green box is. That's effective, and I'm boiling it down. I'm giving it in very simple terms. If you guys really want to know more about market profile, you should absolutely look into it. There's a guy by the name of James Dalton. He wrote a book called Markets and Profile. I think that's the second book. The idea is that the idea is, oh, I need to see if there's more people in the waiting room actually really fast. No, okay, we're good. The deal is that during the day it captures the movement of the market, and that's what these green areas are, is where it is at 70% of the time. The blue line that it is jotting, that is the high and the low of that day. And mind you, you can see, I realize it doesn't really show, but this is the 20th, which is this day. This is the 21st. This is yesterday. And as you can see, and I'll show you what I'm talking about in a moment, it has influence on the trades and how they are behaving for the current day. And to show that, you can see the market came down, and right down here, you can see it basically went just barely below that value area low and rejected and went back up. And then this one came up here, and you can see that it got just above the 53.40, which is the POC. And then it rejected again, and then came back down, and then it came back up and got almost to the POC, and then it rejected again. And again, we got down here just barely below the value area. It came back up a little bit, and then it just failed and just went down. And you can see right here, it actually did come down, and then it did a retrace right at the low of the previous day. This is why it is very important to understand what the data is from the market profile. And if we look at, so we're going to look at today. I'm going to go back to today. So this is the ES chart from today. So you can see, so we opened up and we ran up, and we actually, and this is the interesting part. This is the reason why I have multiple TPOs on the chart, because it ran up, and look at where it rejected, right at the POC from 2 days ago, from the 22nd. And then it fell down, and then it got to the value area low of the 22nd, came back up, didn't quite get to the POC, came back down, rejected off of the value area low again, came back up. Oh, wow, I guess it's closing all the trades. I was just hearing a bunch of dings in my ears. Then it comes back down, comes back up again, rejects off of the POC, or I'm sorry, the settle from the 2 days ago. I guess settle is what I meant to say. If I said POC, I apologize. And then it comes back down and then rejected down. This is the ES. I'm going to show you the NQ. Same, similar kind of thing. It came up. You can see that it actually got to the settle from 3 days ago. It looks like it kind of rejected roughly in that area, then came back. Then you can see right here, it got to the value area high of 2 days ago. Then it shot straight up and then came back down. And then look at this right here. It rejected off of the value area high from yesterday. This is the reason why it is good to understand market profile, because it has relevance. When you see it rejecting or when you see it interacting with these levels, it's important to keep in mind what it's doing, because it may be an area of resistance, it may be an area of rejection, and there are times when it just shoots straight through and it makes no difference. Obviously, it depends on how the market is behaving, and you have to keep all of those things in mind. But that's the main gist of it. So what I wanted to do is run through some days, and just to give you an idea of how this actually operates. So this is yesterday. Now, this first trade, I'm going to show you the NQ and the ES. I'm going to have to go through these pretty quick, just because I want to get you guys to see some of the days so you can understand what is happening and potentially how you would use that in order to know how to trade it. On this and this is the same day. So this is the ES, this is the NQ. So the ES was a bit stronger yesterday. This first trade, and I'm sure you guys can see the arrows as they're popping up. So you can see that basically gets in right here. It caught along. Again, this would be where you would get in, you would take the trade up, and you would get out somewhere up here, and then it comes down, and it actually, in this case, it gets out of that trade on this way down. But of course, you're out. So you got in, you got your 15 or 20 points, whatever you're looking for, and then you get out and you can see where it gets in at 1028 would be this green candle. You can see, again, just so we're all clear on, this number is just a reference. Even if you got in right or didn't get in right here and didn't catch it right there, and you waited until it came back, it does come back and rejects right off of that 75, which would be a significantly better entry than 87. So just because it shows up doesn't mean you should take it. I'm not saying you shouldn't or that you can't, but it's just a matter of what your appetite for heat is really what it comes down to. You would get into this trade. So let's say you waited. Let's say you get in at 82. So it comes back up, and then it's you see that it's already moving back up. You get in at 82, then you write it up to to 10. I think this is actually going up to 10 or 12 right in here. And then you get back out, and then you see it fail. Now, keep in mind, you can see this comes down. It basically goes through the POC. Now, this is where it gets a little tricky. So it goes through the POC. It goes through the open of the previous day, but you see that it rejects before it got to the settle of the previous day. Mind you, these are in varying degrees of importance, meaning the previous day is more important than 2 days ago, is more important than 3 days ago. So it's always important to focus on this TPO before you start looking at whether or not there are references in the previous ones. And mind you, and the convergence is kind of funny, because you can see the settle from the previous day is right there at the 18,800. And this one's a little bit below. So theoretically, you could say it's rejecting off of both of those settles. Or, I mean, they have convergence. They are within a small amount of each other. You can see that the close of this one was 792, and this is right. I think this one is at 799. So within 7 points of each other, which on the NQ is actually not very far. So you can see there is a convergence of how the levels that they operate in. So then it rejects. It comes back up, comes back down. Then this one comes down. It kind of gets just below the value area high. again, rejects back up, gets just above it, comes back down, and then it finally just slides right through. It does do a little bit of a bounce right here, which is probably a little bit of slippage off of the settle, pops back up a little bit, and then it just continues down. Okay, so that first trade, again, you would take the trade up, and then when it comes back down, when it rejects, again, this trade had already closed, so maybe you don't want to take that trade again, but this one right here, yeah, this one you would have lost, because if you would have taken it, it doesn't. And this is the other thing to keep in mind. If this number is 0, well, especially on the NQ, if this number is 0, if it doesn't show any max above 0, you probably don't want to jump into that trade. This is one that you would wait. You want to wait until you see confirmation, because again, this one's 28 points. You're going to at least get something of confirmation before you have to jump in. This one's 15, and then we get to the 192 point with 0 points of heat. And mind you, this is a short, so if you had literally gotten into this trade, you would have gotten in right over here, and you would have been able to write it down. I mean, without significant concern, I would say that you could have written it down. I mean, the entry on that is 18 or 814. You could have written it down to, let's just say 700. So that's 114 points with very little. I'm feeling like I'm gonna, have a panic attack because I'm in a trade that's upside down. And that's the reason why there are focus trades, which are separate, because the idea is to give you guys something to look at and use as reference, that isn't just a bunch of trades being thrown at you, which is what the goal was. Okay, so that's the NQ. Same thing on the ES. ES, this trade right here, it's a short. If you had just waited a little bit, again, so it got in, so 53.29 quarter was where it got in. But if you had waited, you could have gotten in at 23, 24. So again, a 5 point better, or 4 points better on the entry, and then you could have ridden it up to let's say 34. So 24 to 34, that's a 10-point trade right there in the first half hour of the day. Well, let's say 10:10, so 40 minutes of the day, first hour of the day. And then again, and this thing goes on until 11:52. So again, so you would have taken that first one. It came back down. It got back down to the 29 entry, which the 30 is that level. So once it got back down, you could have gotten back in somewhere in here. Once you saw it going sideways and then it bounces up again, you could have gotten back in, ridden it up to 34. So get in at, let's say, 27 to 34, again, 6 points. Then you get out, it comes back down. Now, this is a straight, and this is the key, is it's a straight shot. When it's moving right through that level and moving lower, you're saying, I've already taken it twice, I'm just gonna wait. I wanna see what it does. Now, as it comes down, and this is the reason why TPO is so helpful, you can see it basically gets to the bottom of this value area and rejects. Now, when it starts to come back up, you would potentially get back in. And keep in mind, you're not allowing it to take 10, 15 points of heat. You're only giving 3 to 5 points should be a reasonable amount depending upon the day. I'm not saying that's every day, because there are days with volatility where that's not even reasonable. But 3 to 5 points should be attainable as you start to use this and get used to how it trades. Let's say you get back in at 22. Now it does go up to 25 and then comes back down to 20, let's say 21.5 is probably where it's getting to. So a half point of heat, but then it shoots straight up. And then you're at 32. And then if you stayed in the trade, you could ride this all the way up to 42. And then again, so now you've taken it once, you took it a second time, now you're taking it a third time from a little bit lower because you were patient and waited for those entries. and then it comes down, and then you can see that this gets, and again, this is the convergence piece. It comes down, you can see it gets almost to the settle and rejects. Now, it's potentially another entry. You can see that there's a short in there somewhere, right there. So you're not getting in where that short is happening, but that does tell you that, and you can see that it actually gets in that short right at the top. So that would be a point where you're like, well, I want to get out of this trade, which is when you potentially would exit. So then when this comes down and it rejects off of that, it's again, that, oh, these are shorts. I'm sorry. Anyway, you get the point. Oh, this is a short. Okay, I apologize. This is a short, not a long. So when it comes down, the points are going against it are up to here, but it's the same principle. So you would get in over here, and okay, so this is a good example. So when you get in, if it goes against you, you're like, okay, I'm not getting back in. I'm going to wait. Then when it comes back, you potentially could get back in, and then of course it does play out. Now again, when this short up here, when this short gets out, yeah, see, it goes all the way. So then you could potentially take it here. You would have lost that trade. Comes down potentially here, but that one you would have won. And then again, when it gets back in up here, then you could have taken that. Now this is the short, which obviously is the key to how this thing works, or why it works well, is that if you take it, if you had taken it from here, again, 0 points of heat, 57 points of profit. And once it gets below that settle, it was kind of a free for all, and then it pretty much just failed from there all the way down. So that's okay. So first I want to ask, are there any questions that you guys have that I can answer? I'm trying to make sure that I get all the questions answered if there's any questions. All right. So then here's my plan. I'm just going to start going through days and then showing you the trades and giving you guys the information on how it works. And I'm going to do it for both EQ and NASDAQ. So
Hey,
here's the,
Stacy, there's one question in the chat.
okay, so settle has to do, so there's a close and then there's a settle. So there's a close, which is what the end of the cash session, and then there's an hour where the markets, and we're in that settle period right now. And it's when after the settle period is done, that is called the settle. And the close and the settle usually are relatively close to each other. I'm not saying that they're exact, but they're usually relatively close to each other, but they're slightly different. Now, I use them synonymously because my charts do not show a difference between the two, and it is rare that there is a significant difference between the two, but it is good to know that what they are. My charts are based on the close. They are not necessarily based on the settle, and I refer to it as settle, and I probably shouldn't. But the idea is when the market is done for the cash session, that is the level that the yellow line is. Oh, I guess I didn't go through all of that. So the green box is the value area. The red line is the POC, which is the place that it spent the most amount of time. The yellow line is the settle, and the light blue line is the open. Those are the different pieces of the profile, of the market profile. So to answer that question. So this day, far easier to play. There was only one focus trade. It gets in way early in the day, right at 10 o'clock. It takes 1 point of heat, which is kind of a no-brainer, and 36 3/4 points of potential. So again, you would potentially get in, and again, this would be a trade that you would take multiple times, where you could have gotten in at 43 3/4, ridden it down to 41, or I guess it depends. I mean, you could take and this is that 3 to 5 points. If you're in at 43 3/4 and you didn't get out over here, it gets down to below 40. So let's say it gets down to 39. You potentially get out when it comes back to 41 or whatever. Then again, it comes back, and then you can see that the POC from the 2 days previous, it hit a level in here, and then it rejects. And then potentially you'd get in again. Let's say you ride that down from, again, once it gets past the 43, that's where you're like, okay, or maybe just slightly before, either way. But let's say 45 or 40, yeah, let's say 43. So it gets back down below that. You're in at 43, you ride this down to 33, 30, I guess 30, yeah, 33. So that's 10 points. It kind of, well, let's say you get out at 35 because you have your stop following. So then it comes back up. It gets basically to 42 and rejects again. Again, you can see the convergence line right here, right now. Now, mind you, this is the POC and the settle of the previous day. Sorry, the close of the previous day. Similar references. And then it rejects again. This may be a point where you get back in, or maybe you get back in over here. It comes back down. You take that one, comes back up. You get in again. It comes back down. And this is the reason why I try to keep this only showing one time, because it's going to be useful for a while. Typically, I'm not saying every day, but typically. So now I've shown you 2 days on the ES. We're going to go to NQ. This one again, so it's I think it's a single trade. Oh no, this one does two. So this one, it gets in a little early, and it ends up getting stopped out. Now the way that these trades work is the 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 regular trades, the way that they work is that it gets in with potential of 5 points of heat, and then as things progress, it looks at the data and says, should I give it more freedom or should I close it out? And if it sees that it's working for the direction of whatever that trade is, it gives it more potential heat, which is why this one is allowing for 27 points of heat. The benefit is that it keeps the noise of 27 trades showing up in here down. And part of that helps to keep the number of non-focused trades to a minimum and gives you the ability of only having to worry about the focus ones. The focus trades have a set number of points, or I apologize, on the NQ, it's 25 points by default, and then it allows for more points as it goes. For the focus trades, it allows for a hard set 30 points. That's it. Once it hits 30 points of heat, it closes a focus trade. That's just how it works. This one, it was going in the direction for what it saw data that was giving it good data, which is why it allowed for more heat. But obviously, in that case, and again, these are not trades that you would potentially take, so it's irrelevant. But if you had taken this trade, you could have gotten in. So again, this is a short. So if you had waited, if you missed this entry and said, "Oh, it went past me. I didn't make it," you just wait. It comes back, and I mean, potentially you get in at, so instead of 18803, you could get into 1823 and not taking any of this heat at all. And then write it down. I mean, 170. I mean, I can't imagine anyone. I don't think I've ever had a 100-point trade. I'm sure my nephew has, but that's not a common amount of points. But I'm just saying, once you get in, as it's coming down, I mean, it never, as you can see, it is basically dropping like a rock. And if you got into a trade as it was coming down or going past that level, it's a potential boon. And again, not in full weight because you've already taken it a few times. Maybe you don't need to be in, your 5 full contracts or whatever. But okay, so now that's 2 days. I'm just going to start going through days. And if you guys have questions, please ask in the chat, and I will stop, and we can go through more information. So I've given you guys enough information. So because this is a very relatively small range day, and this is going to be a difficulty no matter what. Any trading model will be difficult to trade on days with short ranges. And here's the other thing: look at market score. they're basically in alignment. They don't move very quickly. They don't move very far. Look at the difference between that day and this day. So you have a very big disparity between when it's moving. I mean, there's a very when the upside is up, it's very clear. And this day is very, very clear. Um, and that's the key is on this day, they're basically right in alignment, right in line. And when you see these trades, again, you're not jumping straight in. We've already had that discussion. This one would not be a bad trade. You'd get in, it's a long, you'd get in, uh, and it basically comes to that level of 33. So you could get in right here, or you could wait until it got back down to that level again and then get in again. And then ultimately it comes back down a little farther. Again, you would get into it again. And this is why these work. So you could potentially, even if you missed it the first time, when it comes back down to here, you're like, oh, and again, it's bouncing. So you can see this is bouncing off of that close. Um, this is it's bouncing right off of that close for right here, which is what moves it up. So when you see it get to there and it doesn't get through it, that's potentially another reason why you could get back in and then jump back up. So anyway, so then again, when it comes back down and it comes through here, you can see it does bounce off of the close of the previous day, 2 days previous, which is the open of the previous day. Again, you can see a convergence. The close of the 17th and the open of the next day are dead on. And keep in mind, we have the Globex session between the two, so it's not like it didn't move between those two. There's definitely a lot of movement between these two time frames. And then when it comes down and it doesn't make it past it, you get back in because that long doesn't end. And here's the other thing. So you can see when it gets in and you can see when it gets out. And that long stays active for the whole rest of the day. Now, this short comes into play, but when you're seeing it, and this is the thing to keep in mind, when you're seeing that movement constantly to the upside, and as much as the strength to the upside, again, market score was not necessarily a perfect indicator or a clear indicator. It did what it was supposed to do, but it wasn't necessarily as strong, and the market range was not as capable. But it, it the strength was to the upside for this day, and you can see that these trades. And the other thing to keep in mind is how often this number beats this number. It's that's the main factor of what really makes these focus trades work. Even on days when there are other trades where, again, you will find trades that exceed those numbers, but the key is to have those trades be consistent. So now let's look at the NQ on the 21st. So this first trade, it's a short. So it gets in, and then you would write it down again. So it's 14 points. This one, I mean, depending upon how volatile it is, and it looks like it's pretty volatile at that point, that one might have been a little bit hard to play. But then we see another short, which is later on. That one's much easier to play. This one would be difficult, but again, we've already had this discussion. You're looking for continuation. So when you see it basically breaking that settle, that might not be the time to just immediately blindly jump in without a very tight stop. Maybe you're looking for it to give a little bit more proof that it's actually moving in the right direction. Then it comes down, and then we have this one right here. And this one is a little bit more clear because it's basically breaking above that settle a second time after already being rejected off of that value area low. So it already spent an hour moving all the way down, hour and a half, moving down, and then not getting through the value area low and coming back up. This was the very first time that it broke that. That's the reason why you want to be careful. And these are all things to think about in how you are actually trading these trades. So then let's move on to the 20th. This Yeah, this day, again, a very tight range. This day was, and keep in mind, the number of days that it does something like this is not a lot, but the importance is when you see these numbers not diverging significantly, they do diverge in here a little bit. And so again, you have the potential of seeing this entry, of taking this trade and having it go well, of waiting until it comes down further. So this is the key, is maybe you don't get in at 44, you get in down here at 41. And then if you're in at 41 and it's moving up, I mean, 46 doesn't look that bad. The 46 was the max that it took. But again, we're only at 24 point range for the whole day. So, at that point, you're no longer taking the 5.25 points of heat. You're taking, let's say, 1 or 2 points of heat, and this is more like 8 points or 7 points. Oh, I'm sorry. I guess if you got in at 41, it would be 5 points. So the idea again is to look at what it's doing and then decide whether or not that's a trade you want to take. This one right here, now here's the thing. It already went up. It did not break the 2-day previous high, and then it failed, came back down, got into the value of 2 days previous, come back up, and then failed right through there. This trade, even though it's a focus trade, is not a trade that you're taking. You're saying, nope, I don't trust it. I haven't seen it show me that it's actually still going to continue. I don't want to take that trade. And that's sort of the discernment that you need, separate from the other part of it. Hold on, wait, I see a question. Would you take a counter trade? So the counter trades, I would say yes. And there have been times that I've taken counter trades. On a day like this, when it keeps rejecting off of these highs, I would say that this trade right here, when this thing gets in, it gets in way early. And mind you, it only takes 3.5 points of heat. But when it starts rejecting off of that high, I might take that trade a couple times. I'm not, and again, I'm not saying you can't or shouldn't take these trades. I'm just saying those are not the ones that are the focus of what this model is meant to do. But there are days when it has value. I mean, here's a 9-point trade with a 0.5 point of heat. But again, it's for your information. You still have to read the market. I can't write, that's the struggle that I've had. I can't write code that can read the market like a human can. The market is just too volatile. Sean, with all these yes, you can go look at any of the days, the playbacks of the days, and just scroll all the way to the very end and see all of the trades. You can see all of that on any of the playbacks on the YouTube channel. So if you want to go see any of this data for what happened on that day, you can go and find that on the YouTube channel, and it will show you all of the heat before peak and the max for that day. So okay, so let's go take this one to, let's go to here for the 20th. Let's see what the NQ, and this was part of the reason why I was actually working on switching to the NQ. So look at this one. So this one had an entry of 18, and again, you're not getting in that entry. You're getting in lower, but you potentially take this for 40 points. Now, mind you, the 40 points is if you had taken it all the way till the end, and the 40 points are up here. But again, let's say you get in down here at 40, you ride it up to 50, and then you get out, and then it comes back. Or well, I guess you would probably want to stay in because it's not coming back to that 40 level. So you're just basically in it. So let's say you get out up here at 60. Then it comes back down again, and here's the thing. When it gets past this level or past your previous level, when it gets to the 40, you take it again. So in this case, you take it at the 40 and it comes down and stops you out, or maybe you only get a point. But then it comes down to the 30 and it's rejecting off of this value area from 2 days ago. Maybe you get back in, you write it up again to the 50. and then get back out. It comes back down again. You potentially get in again and then ride it up. And at this point, it never gets back down here to this 35, which is where you're the 38 where you got in, and it just rides around, and then it shoots all the way up to the 90. Obviously, whether or not you take it for that length depends upon your appetite for just rolling with it. But again, another trade where you're taking it multiple times. That's 4 times that I called out. So even though on the ES, this day was not the easiest and it was a very tight range, the NQ, a little more volatile. So you have to be able to be able to figure out how to ride it. But that heat before peak is not realistic because I would not have gotten into that point where it was coming in. But 40 points is not a bad outcome. So anyway, you get the point. All right, let's move on to the next day. 17th. So now we're getting into days which, again, not a significant range. You can see that there is not a significant divergence. There is I mean, you can see the downside was winning all day long. And this is the key to understanding how market score is valuable way early on in the day. So I want to just point this out. So at 10 o'clock in the morning, the market has been open for 1 hour. Look at the number of highs on the downside versus the highs on the upside. 5 and below is considered weak. 15 and above is considered strong. And look at the number of lows on the downside, 1. The number of lows on the upside, 16. So by 10 o'clock in the day, by a half hour into the market, you already know there is significant strength to the downside. Now, mind you, that doesn't mean it's not going to move up. And as you can see, it does. It moves back up. But the key that I'm pointing out is that late in the day, we get a complete liquidation. And I'm not saying that this data is going to happen and that's going to cause it every single time. But more often than not, when you are seeing that level of strength to one side and not the other, it is very, very likely there is going to be significant movement in the direction of strength. And on this day, as you can see, it progresses through the day, and then it gets to the point. And keep in mind, I want you to watch the convergence. This comes back up. It gets just above the settle, and then it fails. And then it goes up and it gets above the settle, it gets above, and it's trying to actually get probably to the POS or to the value area low of the previous day and fails. And then it kind of gets down here gets down below the low. You can't see it, but the low is right in here. Gets below the low, comes back up, gets about to the settle, a little bit above the settle, fails again. Then it comes back up, and then basically it's riding the settle, fails again. Gets back up, rides the settle again, and then has a complete failure and drops all the way below the value area low of the 2 days previous. This is why understanding the TPO and watching what the market score is showing you is key. Because by 10 o'clock, you already knew I'm going to see some movement. I mean, it's not necessarily going to take the low or break a high, and sometimes it won't. Like there was one day when it was just like this, and it basically moved up all day, and it went up, I think it was up 60 points by like noon. Noon, I'm sorry, 1 Eastern, and then it dropped 40 points. And so understanding the strength in one side versus the other gives you that ability to be able to plan and understand that just because I am moving up doesn't mean that I'm staying up. It's all about what the data is showing you. So and then the other thing to keep in mind is, so when you see this reject, this is another reason why it's important to know levels. When you see this reject off of that settle and fail all the way down to this value area low from 2 days previous, when it bounces, you bail. You're like, that's a significant level. I know that level is significant because I know it's a reference from 2 days previous. I am going to be done. I'm getting out of that trade. There's no reference. I mean, there's no, it's not taking a long or anything down here, but it's important. And I shouldn't say that you definitively should bail. Obviously, it's based on how you want to do your trading. But when you see it hit a significant level, it's not a bad time to get out, or at the very least, get out of the majority of your position. If you have 5, or however many contracts you're in, get out of the majority of your position and leave on a runner and only give yourself 3 points of heat. Okay, fine. I'm going to put my stop. So if you know that this level, so the value area low, which is the V low on, you can see the little pop up, is at 5306. When it rejects off of that, so maybe you put your stop at 9, and when it gets back up to that, you're like, you know what, that's it, I'm done with that trade. And you can see it rejects. It doesn't just say, oh, I don't really want to be at this level anymore. It completely hits that bottom and bounces and never gets back there. And those are all things to keep in mind, that when you're looking at the chart as a whole, it is not just the candles. That's one of the things that you guys, or that lots of people get caught up in. And when I say you guys, I just mean everyone gets caught up in, is that you're just looking for the price. Oh, it's moving up, I'm going to get into a long. Oh, it's moving down, I'm going to get into a short. And believe me, as my nephew can tell you, I have done that a hell of a lot of times, and it is not a good way to trade. Which is why it is really, really helpful to look at all the data and not just go on one data point, because one data point is recipe for disaster. It is not a good way to trade, and ultimately you will lose. Eventually, you will just. I mean, you may win over a period of time, but eventually it will come back and it will bite you, and you will lose. Well, I could say that I have. I shouldn't say that everyone will, but that's for me. But anyway, so when it comes down, you see a significant area, that would be a good time to get out of that trade. Now, mind you, it does come back up, and then you see this long that stayed on the entire day, and it's getting out right as that thing is moving down, which again may be the reason why you're like, well, maybe I can hold on to this short because the long is getting out, which would be why you could hold it into this bounce. And then once it gets to the bounce, you put your stop at 9, and then you're done. So that's that day. Let's go to the NQ. That was the 17th, yeah. Okay, so again, this day is a little bit easier. 21 points, 10 points of heat. I'm just going to run through these numbers just so you guys can see it. 21 points for 4.25 points of heat. And then we get to the fun numbers. 112 and a quarter points for 1.5 points of heat. Again, this is a pretty decent level if it's able to pull that off, but I'm just saying that it's all about, you can see that it does come back toward that level. Even though it's getting in here, it comes back almost to that level a little bit later. So again, if you don't catch it right when it hits, you're like, okay, this is I need to get this level or better. And again, 95% of the time you will be able to meet or beat that number. So just because you missed it doesn't mean you need to be jumping in. I'm not saying that when we're in a freaking pair up to the upside and and we're 30 points above where the original trade started, that you're going to be able to hit that level. Obviously not. But the point is that it is very often that you should be able to hit that. And then again, that's where the 95% comes into play. And of course, if you took that trade and let's just say you got into it here and then you wrote it down for 15 or 20 points, it comes back, you get back to your level, you write it down for 5 or 10, it gets back to your level, you write it down for 5 or 10 or 15 or 20. This one was like 45 points here. So your entry was at 658 and you write it down to 20. Well, it's just about 20. We'll say 27. So that's 30 points, and then you wait until it comes, and again, here again, it comes back up. You're like, oh, it got to my level, and then you wait for it to actually decide what it's going to do, even, or you could potentially get in and just take the heat or whatever in a smaller number of contracts, and then you get back in, and then this time it comes all the way down to 610. And so if you're in at, I mean, the level is 58. So if you waited until it got to 58 and you got in at 58 and wrote it down, now you're in all the way from 58 to 10, which is 40 points. Now, this time it comes back up. It doesn't quite get to there. But again, you can see that it was building up, trying to get above that close. It was trying to get above that close and just not making it. Failed, comes back up. It doesn't get above that close. And let's say you get back in over here at 8:30 or 6:30, and then it fails again. You get out again, or if you just hold on because it doesn't come back to that entry, you could have gotten out at 6:15. So you got in at 30, so that's a 15 point, or it comes back to 27 or so, and then it does a complete off a cliff. It drops right off of a cliff and then runs all the way down. And then again, the convergence, it actually is getting below the value area and then bounces. And this is exactly what it did that other day that I was showing you. Bounced right again. Oh, I guess this was that was the ES. That was the reason why. So again, once it gets through the value area, maybe you're thinking that's a significant level. I'm bailing on this trade. And so now and I don't know how many I said that you could have taken in this. It was like 8 or 9. But at this point, I mean, I'm not saying, and I certainly am not saying you should take all these trades. I'm just saying that if you had taken them all based on those numbers, let's say 2 to 3 contracts per trade, and which I think is a reasonable number. And again, I'm talking MNQ or MES. Just based on those numbers, you're looking at what? I think like 300 points, which I don't think anybody's complaining about 300 points. Anyway, so then it fails, comes back up. All right, so now we're going to go through the next chart. And again, you can go through all of my previous charts. They're all up on YouTube. You can go look at them and see what they show. And the datas that I'm showing you now should match the data that's up there. Within reason, I don't think it's an exact number just because when it goes through and does it, but you'll get the point. Okay, again, so we have this entry right here. So this is a long. Again, if you didn't get that entry, and mind you, it was coming down into that, it was kind of moving along. If you didn't get that entry and you waited, you could have gotten in at 31, 32. So again, another more proof that this number is just for reference. It is not the exact number you need to be worried about getting in. And then, so let's say you only took 3 points of heat, and instead of 12 points, now you have a potential at 15.25 points. Because once it comes down and rejects, it immediately shoots back up. It never gets back down into this level. Now, again, it doesn't really get back down. Once it does that immediate drop, it doesn't get back down to this level either, but it runs back all the way up to the 47. So that's 10 points, 12 points. And then it comes back down. Again, this one, oh, I will say this though, once the opposing trade shows up, I would say that maybe you don't want to necessarily jump into the next to that. So let me rephrase that. When one shows up at 10 and the next one shows up at 10:06, this one is still the active one. I'm not saying you can't take this one. And there are times, and keep in mind, when it is jumping across the settle or the close, you can see that it's basically riding the close right here. And then it drops below the close, jumps above the close, and then it comes back down, and then drops below the close, jumps above the close, and then drops below the close and jumps above the close. These days are days when you have to be certain to not let it go too far, number one, and don't let it go too far against you, and don't let it go too far without taking your points. So it's important to make certain that because days like this are days when it is not going to give you perfect signals. It just isn't, because there are too many conflicting points of data in order for it to give you, oh, just go long and you'll be fine for the whole day. It's just not practical for it to be able to pull that out. So let's move to the NQ. Again, an easier day to trade. The first one, it's dropping into that trade. So again, you would not jump in. There is a short there that you could potentially take, which is 28 points with 0 points of heat. Because this one was active, and again, this is the differentiation. You can see this one came in and had points at max, so it wasn't 0. This one, that first trade got in, it had 0 max. But then when the second one came in this case, this would be the one that you would potentially focus on for the immediacy. I'm not saying you would take shorts all day. I'm just saying that that and keep in mind, and this is something I hadn't mentioned before, but the very first trade it takes is usually the direction of the day. And again, it's also market score. You can see that by this point in the day, uh, the upside is kind of riding above. So and again, so here's another day where it really comes to play. Look at the how many highs are on the downside and how many highs are on the upside. So the even though the upside is on top, and again, this is that divergence where you can look at market score and know what it's doing right now versus what it is potentially going to be doing later. And that is important to keep in mind because as much, and this isn't, I mean, it's not like a huge difference, but there is still more strength to downside. And as you can see, the day progresses and it moves up and we get all kinds of strength to the upside, but now we have 14 for the downside. And that, again, what is the level of strength is 15. So when you see 14 for the downside, there's very likely going to be movement down. And on this day, I mean, again, it comes to fruition and it shows you that the downside wants to take over and it does. And we end up dropping below the open. And again, you knew that, or you knew that there was potentially going to be some movement downside to the downside at, I mean, this is at 9:53 in the morning. That strength is giving, and again, it's not a perfect indicator. It's just very likely. So anyway, um, so the first trade you're not taking, the second trade you're taking, I'm pretty sure most of you could get something out of 28 points with 0 points of heat. Um, then the third trade comes along. And again, this is where you see that the upside is already starting to come up again. We're already starting to get new highs. And there's three parts to market score. There's what it's doing now, which is who's on top versus who's on bottom. There's where's the strength, which is how many highs versus how many lows. And then there's who is making a movement. And right here, the movement on the upside is only showing 5 highs, but right here, we're seeing now 8 highs. That means the upside is currently taking control. And as you can see, I mean, we're barely, I mean, we did the bounce, fine, we did the bounce, but we're barely into that move up and we're already starting to get new highs. And look, it goes from, so it goes 7, and then we have 8, and then we have 9, and then we have 11, and I mean, and it's continuing, and then you get up into here and you get 12 and 13 and 14, 18. So it's important to keep all of that. So there's the three types. There's who's on top, there's who has the strength, or at least strength that may come into play, and then who is making the movement, upside or downside. And that's why there are, just so you're all clear, that's why there are two scores. That's why there's a downside separate from the upside. Because again, strength in one side does not equal weakness in the other, and vice versa. Weakness in one does not equal strength in the other. And understanding that is part of what allows market score to give that insight and help you understand what should I be expecting, or what potentially should I be expecting as the day progresses. And as you can see, even though the upside was kicking butt all day long, because of that strength on the downside, it was it was showing you, hey, we want to, the sellers want to take a little bit of control at some point, or they're going to try. I guess that's probably more to the point. What I'm trying to say is they are going to try to take control. They are going to try to actually get movement out of it. So anyway, um, someone said that some of the things are blurry. If at some point I can probably take screenshots and put them all up, and I'll do that. It's just going to take a little bit of time. If you look at, there's a video called New Trade Model or something like that. If you go through that, it shows you like 18 days in April. So it's very similar kind of thing. You can go in and look at the actual charts on that one, and that one should actually be very clear. And I will try to create more and more of those so that you guys can go back and look at them actually in one video as opposed to having to go through multiple. But that's a longer term thing. Okay, so I'm just going to keep going through days unless you guys have some other questions, because this is probably the easiest way to really understand this. So again, so you can see it. This trade opens up right here. And keep in mind, you can see this little teeny bit of blue. We are way above value area. So the value area is no longer, there's no references on this chart, because the references that would be on here would be from, I believe, earlier in April, because that was the last time we were at this level. So, and at some point I may have it show those other value areas, but for now, I just don't know if it's really relevant. I mean, on this day, it wouldn't be relevant. Again, it gets in at 5,300. 5,300, I guess I should say 5,300 is a significant level. It's a psychological level. So when it hits that and it gets in, and again, oh, you're like, oh my gosh, I missed that trade. And now you're able to get in at like 97, 96. So you're in 3 points lower than that. So, and then it goes for 29 and 3/4 points. And it literally, if you got in at 96, it literally never gets below you for the rest of the day. You get into this trade and you just hold it. And and or worst case scenario, it goes up and you're like, oh, we got above 5,300. I'm going to take my 3 points and I'm going to be done. It comes back down to 56 or to 96 again. And you're like, well, I already got some points. I might as well, I'm going to get in and see where it goes. Maybe you only get into one contract this time and it goes up. And then at that point, it never gets back there. So maybe you add on after you get above 5,300, because you're like 5,300 is that psychological level. So I get into 2. So now you're averaged in at, what is that, 98-ish? So you're in at 96, you're in at 98, or you're in at 5,300. So your average is 98. So now you're in 2 contracts at 98, and then you just ride it up, and you keep going and going and going. And then on this day, it's again, it's how long are you willing to be in a trade? Again, I told you my average time in a trade, I think, is probably between 15 and 20 minutes. I think at one point it was up at 40. But on days like this, when it never comes back down there, maybe you just put your stop at a certain level and just monitor it. Is it coming back to me? Or maybe you put it at 3 points in profit and just let it run. Or you put your exits as, oh, I think it's going to get to here. I think it's going to get to here. I think it's going to get to here. And then you put your stop 3 points in profit and let it ride and see what it does. Oh, yes. And Brad's right. If an opposite trade shows up, and you can see, and here's the key, look when this trade shows up. Look when that short shows up. So if you got into this long and you're like, I'm just going to hold this. It's not getting back to my level. When this opposite trade shows up, that maybe, that's a decent time to get out. And if you got out of even if you got it at 5,300 and you got out at 25.5, that's like what, 24 and 3/4 points. So it's a reasonable trade, or 24 and 1/4. I'm sorry, 24 and 1/4. No, it would be 24 and 3/4. So 24 and 3/4 points. That's like Brad said, you can just wait until if it's not getting back to your level, just wait until an opposite trade shows up. And it won't happen every time, because the market just doesn't work that way, but it isn't uncommon. I would say that it's probably 70% of the time there will be an opposite trade that will show up that has a reasonable exit. And I can't imagine anyone in here thinking that a 25-point trade is a quote unquote okay trade. I think everyone in here understands 25 points that's a badass trade. If you're getting 25 points in a single trade, you're doing something right. So anyway, move back over to the NQ. Yeah, so the NQ just freaking kills it. All right, so 17.5 points of heat. Again, You're like, oh, I don't want to, I don't want, I want to wait. I want to see where that thing comes to. You don't get in at 21 quarter. It comes down all the way to, I mean, almost to like, what is that, 505, 18,505. So you're in 15 points lower, or let's say 10 points lower. And then you could write it for 185 points. Or you could, because so you're, let's say you're in it 510. You could write it up to six, when this one gets in, 685. So that is 155 points. Again, I can't imagine anyone here thinking, oh, that's not really a good trade. 155 points. That's a I'm done for the month kind of trade, kind of thing. Anyway, and here's the crazy part. If you are in MNQ for, let's say, 3 contracts, and let's say you add on a couple as you're going. So let's say you're in for a total of 5. Let's say you're averaged in at like 40, and it goes all the way to 18,655 or 18,6. Well, 18,685. Oh, well, okay. So I was off. It was actually even more than what I was saying. So 100 and yeah. Anyway, it's just a big number. We'll just roll with that. It's more than 150 points. So let's say you're averaging it at 540, and it goes all the way to 6. We'll just say 650. I'm not even going to go all the way to what that entry is. We're just going to say it goes to 650. So you're in at 540 and it goes to 650. You're in 5 MNQ contracts. I don't know what the number is, but I mean that's a lot of points, or that's a lot. I mean it's a reasonable. It's all about maximizing how you're actually doing these trades. That's the key. Again, you're in the trade for a very long time, but it's more about potentially working with what market score is showing you, and that's the goal, is finding how it works and what to do when the trade is working. Again, so this one shows up. It takes 8 3/4 points of heat, but you're not getting in at the 52.50. You're getting in, it goes up, it comes back down. Let's say you do get in, because I think 52.50 is right there. So let's say it comes back down, but you can see that it kind of meanders right there. It already went into profit. It won't be 24 at that point. But let's say it's a point of showing max. So you're like, okay, I take that trade. Let's say you do get in at 52.50. It goes all the way up to 54. You get out, comes back down. This time it comes all the way down to 46-ish. So this time you say, I'm going to take it when it comes back to 47, or even 47.5, which is, whatever. Anyway, you get it back in. Then you write it all the way up to 57. Then it comes back down. It goes and keep in mind, I want you to take note of where these levels are. It comes down. Look where it's rejecting. It's basically at the close. It's popping up because of the close. Comes back down, doesn't quite get to it. Then it goes back up, comes back down. Look at that. Came right back down to the close. Then pops up again, comes down. This time it says, up, screw the close. Comes all the way down. Oh, look at that. Popping right there off the value area low. That's why these references are so crucial to pay attention to. Because you will notice over time, you will see where it is rejecting and what it is doing and why. So when it is rejecting, that's telling you when selling is stopping, that means that nobody's buying. And when it stops going up, that means nobody's selling. Or I'm sorry, yeah, well, when it's going up, nobody's buying. When it's going down, they stop selling. The selling is shutting off at the bottom, buying is shutting off at the top. So it's rejecting off of that value area low, comes back up. We do shoot through. It does, and you can see it. It does a little bit of jumping across that settle. And again, the close, pardon me. That close is a very key level. That's why it's doing this, because it's a level of resistance. And again, the keys are the value area high, the close, the POC, the value area low, the high and the low, and the open. Not all of them are relevant at all times, but they all have their place, and it is not uncommon for them to actually all play a part at some point. So then we shoot back through, we come up, there's not really any significant, I mean, I guess you could say that it was off the open of the previous day, but let's just say, I mean, I guess this one does come right to it and then fails. Comes back through again, look at what it does. This comes down, gets right to that close again, pops back up, comes back down. This time it pushes through it. It's kind of riding the POC right here, and then drops back down. Oh, wait, look, right off of that value area low, and then it shoots up like a freaking rocket. Okay, so 24 points. Again, you would have taken it. So let's say it gets in here, you take it 1, get back out up here, get back in, 2, get out, it comes back down, comes over here. Once it gets above that settle, clear sign of strength as it's holding. And again, your entry for the original trade was 50. You're way below that. So once it gets up into here, you're like, okay, I'm going to take it. So it gets to 40. Let's say you don't get until 47. Again, take that. Now that's the third time you've taken that trade. Comes back down. Then we see it kind of, again, it's hitting reference levels, hitting reference levels. Once it gets to this low and it doesn't stay below it, pops back above it. Once it gets above that settle,